Here we go, another week on the TSP Weekly Podcast. We are in different time zone. No, we're the same time zone, but we're different worlds right now. Yeah. All right, man. Been a pretty quiet week in the market. Tell me I'm wrong. No?
No, you are right about that. I'm not really sure why, because, there's no shortage in what's happening. It seems like today actually is the big day because last night the administration came out and slapped a new tariff on Canada and China. But
did it take effect yet? I didn't see that. Or is it just something
No,
planned?
I don't. To be honest, I'm not sure. I think it's probably planned. I mean,
I can't keep up with it. Yeah.
Right. August 1st seems to be the day when, all the new things are going to go into effect now. But
so I think what people have seen, though, and they started to see like, oh, just because they say it out loud doesn't mean it's going to happen. So it's almost like the Chicken Little thing. It's like people hear the sky's falling so much that they're just like, okay, I don't know, the sky might fall or it might not, but I'm not going to make any crazy decisions. Like I kind of feel like people are numb to that. And initially, not so much, right? They were freaking out. But like now I feel like they're just kind of like, whatever. It's another day, another tariff. Is it really going to happen? What does that even mean? I don't know.
Yeah, that's definitely what's happening. At the end of the day, I just wonder if when these things do come into, if and when they actually come into effect, what will happen then?
Yeah, and what, as far as I understand tariffs, and I've tried to, and I still kind of get confused sometimes as to how they truly impact. It still takes a little while. You don't see it immediately, right? Because the system's working, and it takes a while for that to kind of funnel its way through. So even then, does it make people go, okay, well, nothing really changed. It's in effect. And I don't know, man. It's just, it's such a confusing time in the financial world. And it's not just because of the new administration. This has been, we talked about this, I think at least the first time 2 or 3 years ago. It had to be because it was, it's even longer than that now. I keep forgetting how long we've been doing this show, but we started talking about it after COVID. All the crazy things that happened for a very short time, but how the rules kind of changed. Just simple things like the 60-40 split, right? 60% stocks, 40% bonds. That's diversified, and you're going to be good because when one goes up, the other one goes down, and it's all inverse and this and that. Nope. None of that's true, and it gets even more complicated after that. Like it's all the rules seems to have been impacted for various reasons, whether it's administrative decisions or, COVID or whatever, right? It just seems to be like I don't know. I tend to fall on the side of, it's like 10 different things happened in the last 10 years that slowly changed all the rules. And one of the biggest ones is just the involvement of the retail investor. You just didn't see the level of involvement in the market that you see now between passive 401k money coming in, right? And then your Robin Hoods and your, all that stuff, just giving people access to the market that never really did. You don't pick up the phone and call your broker. That doesn't happen anymore. Maybe it does.
There's so many things. I mean, certainly one of the biggest is interest rates bottomed in 2020, right before COVID. And then rates have gone up, like the rates went up really fast. The Fed poured a bunch of money in post-COVID that took a long time to work its way through the system. Inflation was unheard of since the 70s. Like, there's always like 2% inflation basically, but 7, 8, 9% inflation. And now that's like why the Fed isn't willing to cut rates right now, because we were talking about tariffs. A tariff should be a one-time price increase. If prices go up 10%, that should be it. Whatever you were buying for $10 is now going to cost you $11. That's it. But the Fed is worried about it causing inflation, so that if it goes up from 10 to 11, then next year, if it goes up to 12, it's not because of the tariff, it's because of inflation.
Right. You mix those two together, it's kind of a dangerous little combo.
Yeah. So we'll see. I mean, all you can do is respond. We talk about it all the time. People guess and they anticipate, and there's the numbers and the models and all the algorithms and everything else. But until things actually work their way through the system, you can look in hindsight and say, okay, this is what happened. And people will parse out why, but price will tell you what actually happened, and then you respond to what price does.
Yeah, 100%. What you got for us this week?
All right, here we go. So we'll take a look at what happened this week. We'll do an update on the fear and greed index. We talked a little bit about XLP over NYA. So XLP is consumer staples, which is what people buy all the time, regardless of market conditions. So what it is basically, people are always going to buy Clorox and Campbell's soup and things like that, but they're not always going to buy Teslas. So if you're looking at the XLP, it's investors saying that they're going to more defensive things. And the NYA is the whole market. It's the New York Stock Exchange. So, and then we'll look at that and compare it to the C fund and see what happens when the ratio changes, what happens with the C fund. And same kind of analysis with the dollar versus the I fund. And then we've been talking about Bitcoin quite a bit for a couple of different reasons, and I'm going to do Bitcoin again. And for anybody who's watching, I think right now Bitcoin's up like 4% today. And then the TSP fund charts. So Monday we've been talking about this quite a bit too, because by the end of the year, the Treasury has to roll over, I think it's 25% of the value of I don't know how many, it's like a couple $1 trillion they have to roll over. And they'll do it in, 3-month up to 30-year bonds. And so they have auctions periodically for all the different timeframes of bonds. So on Monday, we had a 3-month bond auction. It settled at 4.255% versus 4.25% last week. So basically not much change. So everybody's worried about this number going up, because if we have to pay more, that's the rate that the Treasury will pay investors to buy the bond. So the more it costs the Treasury for investors to buy the bond, the higher the deficit goes up. So they're trying to get this rate to come down so that the Treasury pays less to investors to buy the bond. And so this is pretty good. They didn't have to pay very much more this week versus last week's bond auction. 6-month, kind of the same thing, right? 4.145 versus 4.15 last month. So that's good. S&P was down 0.79% on Monday. And Tuesday, we had the Red Book Index. It's a year-over-year retail stores, same-store sales. So it's a pretty good indication of what's happening in the retail consumer space. So it rose to 4.9% versus 5.9% versus 4.9% last month. A higher than expected reading is generally seen as a positive for the dollar. So kind of keep that in mind as we get to the dollar piece of this in a few slides. But the dollar has been coming down since the beginning of the year. And the question is whether or not we're getting to a bottom for the dollar. So this is kind of an indication because we were up, a pretty good bit on same store retail sales. It's a positive for the dollar, which kind of lends to the idea that we're getting to the bottom of this cycle for the dollar. And then used cars prices were up month over month, 1.6% versus being down 1.4% last month. So there will be some numbers in there that will put that on the side of inflation is going up. Okay, year over year was up 6.3%. So it costs more, 6.3% more year over year to buy a used car versus last month it was only up 4%. So it's a rolling 12-month number. And the S&P basically flat, down 0.07% on Tuesday. Wednesday, we got 30-year mortgage rates fell a little bit to 6.77 from 6.79 last week, but new applications rose 9.4% versus rising 2.7% last week. So at least there's some motivation in there as rates come down for people to go out and start looking for housing at these prices. I don't know how they're doing it. 10-year bond auction on Wednesday actually closed down. So this is a positive, right? It's down a pretty good bit from the last auction. So that's that's encouraging. We're trying to see all these bond auctions. We want to be less than the previous auction so that we're paying less, so the deficit is decreasing and not increasing. We had the Fed meeting and the press conference last week. It wasn't this week at 2 p.m. It was last week. This week, the minutes from that meeting came out, and so the media was parsing all that information. And then by the close on Wednesday, we were up 0.61%. Then on Thursday, we had initial jobless claims at 227,000 versus 232,000 last week, and the forecast for this week was 245,000. So initial jobless claims are going down. Right, that's good. That was this week. Last week, unemployment had fallen from 4.2 to 4.1%. So the jobs numbers, the employment numbers, continue to be pretty strong. And the S&P was up 0.27% on Thursday. Then today, Friday, we don't really have any significant economic data, but last night we got the tariff stuff about Canada and China, and the market, it's about 11:15 on Friday morning. The market opened down about 0.5%. So we'll see how it closes for the day and for the week. Okay, so CNN Fear and Greed Index is something we talk about quite a bit. This is the trend or the timeline versus the overview. If you looked at the overview of it, it would tell you the actual number, but the timeline tells you the trend, which is pretty helpful. So it goes back 1 year. The zero number is as extreme fear as you can get in the market. 100 is as extreme greed as you can get. April 7th, I think it was, the number was 4. It was one of the lowest in decades. So it was extreme fear on the Fear and Greed Index. Sorry, give me 1 second. Okay. But where we are right now, so since that bottom, right, the market rallied, kind of greed started coming back to the index. And for the past couple of weeks, we've been up here in the extreme greed level at above 75. We haven't been there in extreme greed in the past year. So it doesn't mean that the market's necessarily getting ready to roll over, but we're certainly closer to a short-term top than a short-term bottom. And there are 7 components of the Fear and Greed Index, but these 2 are pretty important right now. So the McClellan Volume Summation Index. So the market's made up of thousands of stocks. On any given day, investors are actively buying and selling them. This measure looks at the amount of volume, right? It's the amount of shares traded, and that's what they call volume. So what the summation index looks at the volume of shares that are rising versus the volume of shares that are falling. So a low number is bearish, right? A low number, investors are getting more risk averse. A high number is extreme greed. And so when we're up here pretty, on the McClellan Volume Summation Index, there's a lot of greed in the market, and it's consistent with making new all-time highs. So yeah, it can definitely keep going higher. The other one that's really important is the put-call ratio. So puts is a bet that the market's going to go lower, and a call is a bet that the market's going to go higher. So when they talk about using protection, right? If you if you have a lot of shares of the S&P 500 in a brokerage account, and you look at a Fear and Greed Index of extreme greed, you don't necessarily want to sell your shares of the S&P 500, but you want to buy something that is going to take the edge off if the market rolls over real fast. So you would buy a put. So when the market is at extreme greed levels, everybody thinks it's going to keep going higher. And so everybody's buying call options because the market's going up. And so puts become very cheap. So it becomes cheap to buy kind of protection against your upside gains. And so the put call ratio when it gets really high, anywhere close to or above 1, so 1 means there's as many people buying puts as there are buying calls. That's a lot of fear in the market. But when it gets down here at 0.6, there are way more people buying calls. Puts are very cheap because nobody wants them, and that's when the market tends to top. Doesn't mean it's going to roll over and crash, just means, we're due for some kind of short-term correction. The put-call ratio is a really good one, especially at the fear levels. And you can see the same thing with the summation index. The volume was really low back here in April. Fear and greed index was really high, and that's kind of indicative of a bottom. Okay, so XLP versus NYA. This is a ratio chart. Okay, so we're looking at a weekly chart. Each one of these ticks, the red and green ticks, is 1 week of price movement. And it's the XLP, which is consumer staples, relative to the whole index. And so when the line is going up, there's an increasing fear in the market. People are rotating out of consumer discretionary things like Tesla and into consumer staple things like Campbell's Soup. So what tends to happen, what I did on this chart is the big moves that have happened. We've had 3 of them since 2015, right? The trends tend to take a long time to happen. So we've had 3 big down moves since 2015. And this is using what's called a measured move. So the distance between this top and this low, right, is the length of this line. So if I cloned this line and brought it over to this top, and that, we had all that churn right there at that level. Okay, so the same distance on that line. So now I cloned it again and bring it over here. So we still have a pretty good way to come down on the ratio. Okay, if the history plays out and the ratio continues to come down to the same length as it did the last 2 times. So that means we have this much time basically for the ratio to come down. When the ratio is coming down, it means stocks are going up, right? When the line's going down, people are coming out of consumer staples. They're buying things like Tesla and ARK ETF and things like that. So if you compare that to the S&P 500, right? All I did was take away the measured moves, and now this is the S&P 500 RC fund. So you can see when people are leaving consumer staples, the overall market is going up. Okay. When they are going into consumer staples, like that was COVID, the market's going down. Same thing in 2022. People are going into consumer staples, investors into consumer staples, coming out of the Mag 7 and the things that usually drive the market higher. So if you remember from the last chart, if we're going to get down here on the ratio somewhere, it's saying that the S&P is going to keep going higher. Okay. To get there, we're close to a double bottom, right? So we have to get below this low, and then it's very likely the ratio keeps going because then it's testing this low. So it's a positive. It's a positive for the market right now. As long as this ratio continues down, the S&P 500 continues up. Okay, and we can do the same kind of analysis with the dollar versus the old I fund. So I say the old I fund because it's the Europe, Asia, Far East Index. It's not the new I fund is the all world ex-US, ex-China, ex-Hong Kong, but we don't have a ticker symbol for that yet. So the dollar has the same, very similar measured moves. We got 4 big declines in the dollar since 2016. All 4 of these black lines are the same length. Dollar got a little bit lower than that line on the first one, hit the bottom on the second one, hit the bottom on the third one, and it's got a little bit more to go, right? We got a little bit more to go in the dollar before it bottoms. So that's why I was saying the red book numbers, the the fact that the Redbook numbers went up a little bit is kind of a leading indicator telling us that we're getting close to that bottom in the dollar, which makes sense based on this measured move chart, right? So if the dollar comes down a little bit more, what does that mean for the I fund? When the dollar comes down, the I fund goes up. Okay. When the dollar goes up, the I fund goes down. So we got a little more to go, about 95.50 or so on the dollar based on that measured move analysis. So we got a little bit more upside on the I fund. But once we hit that bottom and the dollar starts recovering, the I fund comes down. So the only reason I'm really pointing this out is because there's a lot of talk right now about people rotating into the I fund. And it has been a great trade for the certainly since April, it's gone straight up as the dollar has gone straight down. But when the dollar does bottom and turns back up, that's going to be it for the I fund. Okay, and then Bitcoin, we've talked about it quite a bit. BTCFX, so BTCFX in the mutual fund window. If you have a mutual fund window account, this is already, I did this chart last night. It's pretty kind of simple analysis, but it's Bitcoin versus the dollar. This is the last major low in 2024. We had this move up, this pullback, and if we get the same length, so this line is the same length as this line, right? So that's the first kind of target. So we get a target right there. From this low, we come up, come down, this bottom, the same length of this line, we get to the top, right? And the 618 extension of this bottom gives us this channel. So that's a really good target for Bitcoin, and it's about 130 to 135. So we still get a little bit more upside, but once we get to that upside, it's definitely a place to start looking at, thinking about taking profits. Okay. And the TSP fund charts. So, Conan, you unmuted your mic, I think. Okay. So C fund. So we're looking at the weekly chart of the C fund. We got 20-week moving average line here, relative strength index down here. Each tick on the chart is 1 week of price movement. And you can see as long as price stays above that 20-week moving average line, the trend is up. As soon as it breaks down through that 20-week and relative strength gets below 50, price starts coming down. So once we gapped up off of that April low, gapped up through that 20-week, price just keeps going. And until that changes, the trend is up. S fund. This is a 5-year chart. So I just wanted to kind of point out on the S fund, this was the top in 2021. And we are only a percent or two above where we were all the way back in 2021, which it's been a long, flat kind of analysis applies, right? Once we gapped up in April above that 20-week moving average line, it's continued to go higher. So a lot of analysts are looking at this and saying, okay, the C fund has been going straight up since this bottom in 2022. The S fund has been basically sideways. So there's a lot more potential for once the S fund breaks out, it should outperform the C fund going forward. We're not really seeing it yet, but it's certainly a possibility. I fund has been doing great. It was pretty interesting. We had this, obviously we had a lot of resistance here at the top in 2021, came up and tried to get above it in 2023, couldn't do it. Tried again here, churned, and got the breakout right there. And then had kind of retests along the way. And then this big retest that did take us all the way back down. But now what was resistance is now support. We got support there in April, and the I fund took off. So yeah, if it pulls back, ideally we get a pullback to somewhere in here, right? Somewhere in here, get support there would be a great place to get into the I fund at that point. And the F fund, again, this is all dependent on interest rates. We certainly have a high in the F fund here, tested it again here, tested it again here, and rolled over. So, but we have an ascending triangle. So ideally, we'll get a breakout to the upside in the F fund. If it happens while the stock funds are also rising, you're better off in the stock funds. If a breakout happened like this in the F fund out of that triangle, if it happened because stocks were falling, then the F fund is a great option at that point. They're all tools, and you just have to know which tool to use in which part of the economy. And then there's always the G fund that keeps on going up and to the right. Question.
We like that one. Oh, hit the wrong button.
All right, get back.
All right, you hearing me okay?
Yeah, I can hear you now, yeah.
All right, good. Yeah, I pushed a couple of wrong buttons, but that happens on this side when I'm trying to switch everything off. All right, guys, if you have any questions, you can always put them in the comment section wherever you find the video. And if there's no comment section, shoot it to us at support@growmytsp.com, and the support team will get it over to us. A lot of good stuff to watch. Don't take your eye off the market, and keep watching this show every week. We come out at Sunday, 6:30s. All right, we'll see you guys later.
Sounds good. Later.